Hello Kaplan, this is the financial plan for the Millers. I'm going to start off with their goals. They do plan to retire in 25 years with 80% of their current income. They want to be able to pay for 4 years of college tuition for all 3 children starting at age 18. They want to understand the tax implications of the sale or exchange of their rental property inherited by Susan. They do have estate planning insurance needs they need to have, as well as establishing an adequate emergency fund. They had some investment questions I'm going to review, as well as implications of selling Ken's baseball card collection and whether they can claim either parent as a dependent. So I'm going to start off with the educational goal. The calculation I came up with is that they need to save at least $25,671 at the end of each year to meet the goal. To attain this type of a goal, I would suggest a 529 plan. This will allow for tax-free growth on the investment, as well as a possible state deduction depending on where you open the account. Other considerations would be a Coverdell Education Savings Account. These accounts are limited to $2,000 annually. Other things they could do is government savings bonds that would provide for also deductions and growth free of taxes. Next thing is the emergency fund. They do need to establish an emergency fund. Currently I feel that they need an additional $12,800 in funds of liquid assets to have an adequate emergency fund. The retirement goal they've gone over with me. I feel they need approximately $26,325 to be saved at each end of each year in order to attain their retirement goal. Currently, Susan's 403B allows for an $18,000 contribution annually. Ken is limited currently in his IRA at $5,500. Ken could also establish a 401k plan that will allow for the same contribution, up to $52,000 annually, actually. I feel that it is more costly, though, and Ken should really look into more of a separate simple IRA. They're allowed to meet their retirement needs and have him contribute up to $12,200 per year. As far as their rental property Susan inherited, I would suggest actually selling that property at fair market value. They did bring up a like-kind exchange for a property next to Ken's business. However, Ken seemed reluctant to want to add to more liability on his business, and if they want to go over that further, we can discuss that at a further meeting. As far as their insurance coverage, I do feel like they have insufficient life insurance coverage. I recommend Ken purchasing approximately $653,000 in life insurance and Susan approximately $730,000. Ken does have whole life insurance policy. Benefit that is it has cash value. Could be able to be borrowed to, and there are other advantages. Susan has a term life insurance policy. Is less costly and partially is covered by the employer at $50,000. Given their needs for education and retirement, I would say that they should consider just term life insurance policy to cover the deficiency. They do have disability insurance at its own occupation. I feel like this is unnecessary given their duties performed at work. They consider a general life or disability insurance policy for that. Ken seems insufficient. It's only 37.5% of his income. Susan seems more in line with the need for life insurance or disability insurance at 65%. I would suggest they do a general disability insurance and have at least 65% of their income covered. As far as their homeowners insurance and auto, I would suggest increasing the deductible. It seems like it's too low. I would suggest at least $500 to $1,000 for these policies. That will reduce the cost of the policy overall. Liability insurance is needed, specifically a personal umbrella liability insurance policy. This could protect against claims against home or auto, specifically because Ken's business serves alcohol. That could be considered a major liability overall. Ken should also consider forming a limited liability corporation for that business to reduce risk to their personal assets. Their dental and health insurance both seem sufficient, so I can't really make any recommendations on that. I would recommend that Susan take advantage of her flexible spending account. I know Susan's reluctant to do so, but it would actually cover tax-free the child care expenses currently at $4,500. It also covers any dental or medical expenses. The thing to consider is that assets can be forfeited if not used by the deadline. It also suggests a personal property insurance coverage for Susan's jewelry. This would be very minimal cost, easily added to your homeowner's associate or your homeowner home insurance policy. Estate planning, there's a couple things they can do very easily. They could establish beneficiary elections for both retirement and life insurance plans. Spouse should be primary. Children should be equal contingent. Another easy thing they could do is personal instructions for funeral needs. Ones I would suggest being drafted by an attorney would be guardianship for all 3 children, as well as their elderly parents. Wills for each of the Millers need to be done, as well as a durable power of attorney for both, including health care. As far as the investment recommendations go, emergency fund definitely has to be cash or cash equivalents. Education funding can vary based on risk. Generally speaking, it should be higher risk at the beginning of the account, and more conservative investments as they get closer to using the funds. Retirement funds, I really can't make a specific recommendation because not enough information was provided. The Millers did have some investment questions. 0 coupon bonds with their phantom income. That generally comes because the 0 coupon bonds are sold at a discount and pay at maturity. Maturity can be 10 years or more. They're generally government bonds. Phantom income comes from that taxes can be due on the interest, but are not actually paid till maturity. So generally speaking, this should be used in a retirement account where the taxes aren't due till funds are withdrawn. The geometric return Susan brought up. Geometric return is a good way of establishing a return of an investment because it factors in the compounding interest. Given what Susan gave me as 50% loss, 30% gain over a 2-year period, calculated the geometric return to be negative 19.38%. Ken had a question about standard deviation versus beta. Generally speaking, standard deviation is the risk of an individual investment. Beta is the risk and volatility of the overall market. There's 2 kinds of risks you can get from that. As far as the beta goes, an investment with a higher beta, more than 1, is more risky. Lower beta, less risky, more conservative. Systematic or unsystematic risk should be considered. Systematic risk is undiversified risk, can be managed. The unsystematic risk is the risk of the other market, which really refers to beta. So generally speaking, a diversified portfolio will reduce the standard deviation and systematic risk. Mortgage refinancing should be considered. Current rates on mortgage rates have declined. Looking at the 30-year fixed would reduce their monthly payment, and they would have more cash outflows to pay for the other, planning needs. Other things to consider is that the Millers currently have excess income of $6,611. Their church donations are currently $6,000. I feel like it's reduced to $3,600, and it's still acceptable range of 3% of their income. Credit card payments are definitely paid off as soon as possible because they're the highest interest rates on there. Entertainment, clothing, food, and telephone expenses should also be considered to be reduced. Currently at $16,100. Susan did want help with the assessment of the strip mall property. Unfortunately, I'm unable to provide any kind of specific recommendations on that. That would violate my CFP board codes of conduct, which I've reviewed in the plan. And that concludes our plan for today.